Welcome back to Unfoolish Investing, everybody. PayPal just crushed earnings. They beat expectations on EPS, revenue, and even announced a massive $15 billion stock buyback. So why in the world is the stock down over 8%? 8% today. Did Wall Street just completely miss the memo? Or is there something bigger going on here? In this video, we're going to break down PayPal's earnings report, why investors are freaking out, and most importantly, whether this is a buy the dip opportunity or a red flag for the stock's future. So, without any further ado, let's jump into it. Okay, $15 billion share buyback. Amazing, right? Guidance came in above expectations. Sounds great. But here's the twist. The stock continues to drop over 8% in pre-market. So what's really going on here? Why are investors selling PayPal even after this insanely amazing strong report? Well, here's the breakdown. So first, let's go over the numbers to see how PayPal performed compared to Wall Street expectations. EPS, $1.19, $1.12 expected. That's a beat. Revenue, $8.37 billion versus $8.26 billion expected. That's a beat. Total payment volume, $437.8 billion versus $438.2 billion expected. Miss. Venmo payment volume up 10% year over year. 2 thumbs up. Awesome. New share buyback program. $15 billion. That's a big move. That is a big move. On the surface, it looks like PayPal is doing just fine. They're making more money. Their payment volume is growing, and they're returning cash to who? The shareholders. So why the sell-off? It all comes down to what investors didn't like in this report. And there wasn't much, but reason number one, slower total payment volume. TPV growth dropped, right? This is basically the total amount of money flowing through PayPal's system. The problem? It slightly missed expectations. Analysts expected $438.2 billion, but PayPal only reported $437.8 billion. Not a huge miss, but in a high growth industry like digital payments, investors want to see strong acceleration. If TPV growth is slowing, it means PayPal is losing market share or consumers are shifting to competitors like Apple Pay, Google Pay, and Shopify Pay. Why does everybody need to put pay at the end? I think we know what we're doing. And that's exactly what's happening here. Reason number 2, declining take rate. Profitability per transaction, right? The second big issue is the percentage of revenue PayPal keeps from every transaction. Last year, they were only keeping 1.96%. This year, they're keeping 1.91%. This might not seem like a big drop, but when you're processing hundreds of billions of dollars in transactions, a small decline in take rate translates to millions in lost revenue. Why is this happening? Again, we just talked about it. Competition. Apple and Google are chipping away at PayPal's margins. And merchants have more payment processing options than ever before. Now let's talk about profit taking. PayPal's stock has already rallied 43% in the past year. So even though they had a solid quarter, investors are locking in gains and taking profits off the table. This happens a lot in earnings season. You get sell the news events where even good results lead to stock drops because expectations were already priced into the stock. CEO Alex Chris took over in 2023, and his strategy is all about cutting costs using AI. Why does everybody have to say they're using AI? We get it. It's there. Everybody's using AI. Don't need to talk about it. And focusing on efficiency. Sounds great. But here's the issue. Cost cutting is not the same as real growth. Investors want to see PayPal innovating, expanding its payment ecosystem, and fighting back against Apple and Google. Layoffs and AI are great for margins, but they don't necessarily lead to more customers or transaction growth. Finally, the guidance. 2025 expected EPS of $4.95 to $5.10. Analysts estimate $4.90. So yeah, they beat expectations, but it's not by much. Investors were hoping for stronger growth signals. Instead, they got a modest bump in earnings and a big stock buyback. $15 billion. Did I mention that? It helps boost that EPS, but it doesn't fix the real issue. PayPal's growth is slowing. All right. So with all that said, should you buy PayPal now while it's down, or it's a falling knife as it continues to plummet today, or should you sell off? Let's look at both sides. What's the bull case? PayPal is still a major player in digital payments, right? Their AI and automation could improve margins, and their buy now, pay later service continues to grow 21% year over year. I personally believe this is one of the core areas you're going to see PayPal continue to grow. That's why I'm also big into Affirm. Buy now, pay later is that service that people are going to continue to adopt more regularly to buy those big ticket items or even smaller, more expensive items like that PlayStation 5 or Switch 2 that's coming, or even looking at you, PlayStation 6, Sony, why is it taking so long, without impacting their wallet. Venmo adoption continues to expand. Now the bear case. Declining take rate equals less profit per transaction. Intense competition from Apple and Google and even Shopify continue to cut in to PayPal's earnings. Cost cutting instead of real growth, and no major catalyst beyond stock buybacks, which, I'll be honest, hasn't seemed to hurt Apple that much, even with their failure in the Vision Pro. So what's the verdict? If you believe in PayPal's long-term strategy and think they'll adapt, this could be a buy the dip opportunity. I personally think it is a buy the dip opportunity. If you don't want to buy today, you want to watch it for a couple of days just to see if it goes down anymore, feel free. But I do think that between buy now, pay later and Venmo, and they continue to expand PayPal's options, this company will continue to grow. But if they don't start growing TPV and increasing their take rate, they could be stuck in a slow decline. Here's what I'm watching for PayPal's next earnings report. Can they stop the take rate decline? Will Venmo and Fastlane bring in more users? Are they actually innovating or just cutting costs? If they can turn things around, this stock could have a strong rebound. If not, well, we might see it stuck in a range for a while. I would say anywhere between $60 to $80 a share if they can't figure it out. So now, where do we go from here? I want to hear from you, the Unfoolish investing community. Do you think PayPal is a buy the dip, or is this company in long-term decline? drop the comment below. And if you enjoyed this breakdown, hit that like button, smash it even, subscribe for more Unfoolish investing videos. And I'll see you in the next one. Send me an email, unfoolishinvesting@gmail.com. And until then, stay unfoolish.